Hey book lovers, I'm going to share with you a book about Warren Buffett. This book is very good for people who doesn't know investment that well, such as myself. I would consider myself as an investor newbie, and I was looking for this book that could kind of like explain the whole world of investment to me. I didn't want to pick up some Benjamin Graham book and read it and get all this mathematics into my mind. This book in particular, which I'm going to share with you, is called The Warren Buffett Way. It's a very simple book written about how he, a very famous investor, successful investor in the marketplace, figured out a way to beat the market, especially the index, S&P index. He beat it by 2x, 3x. So if you are looking to be an investor and you don't know how, this book is actually going to be very good for you. And I'm going to share the 3 takeaways that I got from the book. Alright, the first takeaway is about focused investing. Now, for me, I personally thought that investing is about spreading my eggs into multiple baskets. I was taught by my parents to never put all your eggs in one basket, which is somewhat true. But in the investment world, I've always thought that a fund manager's role is to spread the money across 50, 20 stocks so that to reduce the risk. But for Warren Buffett, he is applying an idea of investing that came from Benjamin Graham, right? And they preach about focused investment, which is to only focus on a few stocks rather than a lot in order to maximize their profits. Then the whole idea behind this is that if you are able to identify the top stocks in the marketplace, why would you want to spread your eggs across other stocks? Why can't you just put all your eggs into these like 3 to 5 major companies? And the way they do it is they don't look at the stock market at all. They don't look at the current pricing or the pricing in the next one year. They are actually looking into the business and its profitability. So they do a lot of deep investigation, and they study the investment reports, the annual reports. They study about the business, whether it's sound. They also study about the management and whether the management team and the company as a whole is resilient against the market and is profitable, not the next 1-2 years, but the next 5 to 10 years. So a good example of a company that Warren Buffett has invested in for a long time is companies like Coca-Cola. Right? Coca-Cola is this company that sells pop drinks, and we know that every time we think about Coke, it's about their drinks not being healthy, right? But if you think about it, Coke is, the brand alone is valuable. Everyone knows what Coke is. Everyone has drank Coke some parts in their lives. Kids, when they grow up, they know about Coke from a very early age, and the Coke brand alone has got a historic value to it. So Coke is one of those big companies that Warren Buffett invests in because he knows the stocks and the shares will keep rising in the next 5 to 10 years. So focused investing is pretty cool. It's the idea that you don't have to look at the stock tickers every day, like I thought usually investors would do. They would sit in front of the screen and they look at it every single day to see whether the stocks go up and down. But for the focused investors, they don't do that. They look at the company as opposed to the current stock price. So focused investing is pretty cool. If you're not constantly looking at the stock ticker and looking at the market, that means you have more time to do something else, which is to research on the companies that you're going to invest in. And because it's focused investing, you don't invest every day. You wait for the right stock to come by, and then once it's right, the margin of safety is big enough, then they plow all the money in one shot in order to reap the rewards. Alright, now the second takeaway of the book is pretty simple. It's about how he thinks, right? And I think this is where the book is valuable to me personally. on how to think properly. The way Warren Buffett thinks is rational. Now you have the emotion side and the rational side, and most of the time we have both together, the left and the right brain working together. But in his case, right, in order to beat the market, you use less of the emotional side of your brain and rather more on the rational side. Because you're evaluating the company and you're not falling in love with the company. If that makes sense. So rational thinking is the key skill into focused investing. You really want to see how the current company state, evaluate the company inside out, even including the management, and to see it for what it is. And besides rational thinking, the book also shares a lot about the right way to think. Like there was this idea that I picked up called stage 1 thinking and stage 2 thinking. Stage 1 thinking is the way we usually think. When there's a problem, we come up with a solution for it and we think it's the right solution. Most of the time we are doing that, we are on our feet, we're constantly thinking, trying to solve problems. But for a rational thinker is that they will have stage 1 and stage 2 thinking at play. The stage 1 thinker is the one that's coming up with a solution and the ideas, but the stage 2 thinker is the one thing coming in and seeing that idea and evaluating the idea to see whether it's really the right one or not, or whether there's any fault to it, whether there's any gap to it. They will critique the idea and potentially come up with some of the gaps that the stage 1 brain would, the stage 1 thinking would come in and reevaluate. And so you got rational thinking, you got stage 1, stage 2 thinking, and then there's this third one that I picked up, which is mind gaps. Now you can't make proper decisions if your mind has gaps in it, which is lack of knowledge, a lack of annual reports, the lack of data coming from the company, the lack of insights coming from the company, the lack of the due diligence to actually evaluate a company. You don't have all that kind of information. How are you going to make the right decision, right? So mind gaps are a series of techniques that they're using to bulletproof their mind to make the right call as to which investment they're going to pursue. So Warren Buffett has a partner called Charlie Munger, and I've been doing a little bit of research about him, and he's got this thing called mental models, and there are like hundreds of mental models out there that you can use. They're like almost like tools in a toolbox, but for your mind. And most of the time we get it all jumbled up, but they actually have labels for all of these mental models, like cognitive bias, confirmation bias, decision tree, how do you evaluate and come up with solutions for problems, the list just goes on. I was thinking about potentially putting it all together into a book, but who knows, right, in the future. The last takeaway. Now, if you don't have time to read the book, you can just read the last chapter where the author summarized everything, and I thought it was the best part of the book. If you're looking to invest the Warren Buffett way, the last chapter actually details out the series of steps that he takes to evaluate a company. And how he evaluates a company is based on 4 criteria, which they call tenets. You've got the business tenets, you've got the financial tenets, you've got the market tenets, and you've got the management tenets. These 4 key criteria is something that I've been thinking of putting inside a spreadsheet to evaluate a company. It's not like I'm going to invest in a company, but it would be nice to use these 4 tenets to understand where a company's future is, or is how it's growing, right? If let's say you are going to join a new company, it would be nice to use these tenets to actually understand whether this company is good or not, right? Or if you're going to, in the future, start a company and you're going to raise funds, well, maybe investors might look into these 4 areas. Or if you're just going to be an investor moving forward, you might want to evaluate all these companies based on these 4 tenets. So I won't go into details, but we can start off with the management tenet. If you're going to evaluate a company, you need to understand what the management is like. who is running the show, the CEO, the CFO, what are they like? What's the culture like? And how have they been performing moving forward? Have they been open and transparent to the investors? Is their leadership sound? Are they making the right decisions on behalf of the shareholders? Or are they making decisions on behalf of themselves? So that's the management tenet, and there are a series of checkers to go through. Now the other one is the market tenet, how the business is running against the market. Now you have your strength, weaknesses, and your SWOT analysis that you want to gauge the business against the market. Or maybe there's external factors and how the market is shifting. Is it working against or for the company? And so that's market tenet. Now you got your financial tenet, which I think I'll probably fail in this area, and is looking into the books, the financials of the company, mainly to see how they're reinvesting their revenues into R&D or to increase the future revenue of the company, or if they're not doing so, how are they giving it back to the investors through dividends, or are they doing it or not? You also want to see whether a company is cost conscious and is constantly reducing costs in order to increase the profit margin, because this profit margin will actually translate into the value of the shares, right? So the financial tenet is pretty important. I'm not an expert in it, but I know how important it is for Warren Buffett, right? That's why he reads the annual reports of each company and to look at the numbers. And the last tenet is actually the business tenet. Is the business simple to understand? So a business that in the book gave an example of is, of course, Coca-Cola again. And if you look at Coca-Cola's business, it's pretty simple, right? They sell pop drinks. What they do is they buy raw materials to create the syrup, the Coke syrup, and they distribute it to the distributors around the world so that they can mix the syrup with other ingredients to create the actual drink itself, and to bottle it for distribution. So where Coke stands is basically that syrup and the brand and the franchise. No other company can be the same like Coke. Coke is Coke, right? And that's why Coke is pretty much that valuable in the marketplace, and it's got, of course, a historical background. So they've created a moat around them that prevents them from being a commodity. And for any company that is not a commodity, they can increase their profit margin because no one is like them. But when a company becomes a commodity, that means you got another company doing exactly the same thing as you. That's something that could, especially for the business tenet, Warren Buffett would not invest in, because commodities, like I understand, is if there's a competitor that does exactly the same thing as you are a commodity. That means the customers can choose. And when customers can choose, the only way for you to compete with your competitors doing the same thing is through price differentiation. So you drop your price. When you drop your price, your profit margins become smaller. That's not good business for an investor. You don't want that. So stay away from commodities. That's what I learned from the book. Now, to summarize the book, I think it's a really good book for investors, newbie investors like myself. I thoroughly enjoy it. I'm probably going to revisit it again to get my thinking straight as to how to evaluate a company, not necessarily to invest all my money in it, but just kind of like curious about this world. And this book actually opens up the world to people like me. Also, remember the last chapter of the book. If you don't have time to read the book, at least look at the last chapter, and can help you understand a company better. If you want to join before you join a company, or if you are looking to invest in a company, I think you should actually just look through the 4 tenets first, at least, so that you have a better understanding whether the company is going to go down or up. Right? So I hope you enjoyed this little short session of the Warren Buffett Way, the book that I've just read. If you enjoyed, don't forget to subscribe.